forfeited interest, your brain needs to immediately go to tax on the interest, deduct the penalty, two separate reporting lines. All right, so that's the entire testable concept. Alrighty, so now we're moving into dividend income. Remember, dividends are distributions that a corporation pays to its shareholders, usually out of profits. And dividends can come in different forms. All right, so they might not just give you cash. They can give you a cash dividend, but they might also give you things like property, or they might give you a stock dividend. And how the IRS taxes it depends on the type of dividend. All right, so here's the big separation you need to know for the REG exam. Cash dividends and property dividends are taxable. All right, so if Linda Larper owns stock in a corporation and that corporation sends her a $2,000 cash dividend, that's going to be taxable income. So if they send her property instead, like inventory or equipment, or even a tractor that's used at Planet of the Grapes winery, whatever the fair market value of that property is, Linda must include that fair market value in taxable income. Okay, so stock. What's going on? My name is Joey, and I'm the founder of Universal CPA Review. You're probably here because you're ready to pass the CPA exams once and for all so that you can advance in your career and move on with your life. Let me be the first to tell you that I've been there and I feel your pain. But I'm also here to tell you that the CPA exam doesn't have to feel like such a maze, and there is a path to a passing score. So what are you waiting for? Don't waste any more time. Commit to the process because it will pay off. In my opinion, I say let's knock out the CPA exams once and for all. Stock dividends are not normally taxable. All right, same goes for stock splits because you're not receiving anything of economic substance, right? Your ownership percentage hasn't changed. Also, not taxable is going to be return of capital, right? That is simply reducing your basis. And same thing with life insurance dividends from mutual insurance companies. Those are essentially treated like a return of premium, which is not going to be taxable income. All right, so the simple high-level reminders here are what's taxable for dividends will equal cash or property dividends. What's non-taxable will equal stock dividends, stock splits, return of capital, and life insurance dividends. All right, so bottom line is that you should start by remembering cash and property dividends are going to be what's taxable. You can more or less assume that everything else is non-taxable, right? That's a shorter list, so start there. All right, so once again, we're going to dive a little bit deeper into taxable dividends. All right, specifically cash dividends and property dividends. So when in doubt, remember that cash and property dividends are what are taxable. We could assume that everything else is non-taxable. That's for simplicity and going to make your life a little bit easier if you're tripped up at the exam center. All right, so when a corporation pays a cash dividend, it's extremely simple. Whatever amount you actually receive, that full dollar amount is what is taxable as ordinary income. So if Linda Larper receives a $1,500 cash dividend from Planet of the Grapes Corporation, that full $1,500 is taxable in the year that she receives it. Now, if instead of cash, Linda receives property, right, that amount she includes in income is the fair market value of that property on the date she receives it. So for tax purposes and reg exam purposes, when you think of property, whether that's received in the form of wages or it's received in the form of a dividend, we're still going to always use the fair market value. All right, so when you think of receiving property as an individual taxpayer, you're going to equate this to fair market value always. All right, so if a corporation sends her a company car worth $25,000 as a dividend distribution, even though that's not cash hitting her bank account, she's going to recognize the $25,000 of taxable dividend income. All right, so think fair market value at the time received, not cost, not basis, fair market value. Right? The idea here is that she could easily turn this around and sell it for $25,000 if that's the fair value. And therefore, that $25,000 fair market value is going to be the equivalent of cash. All right, so your exam brain should go here. Cash dividend equals amount received. Property dividend equals fair market value of property received, period. All right, so now we're going to talk about what determines whether a dividend is actually taxable in the first place. Okay, because the source matters, right? It could be earnings and profit, or it could be something else. So now here's where dividends get really interesting. And this is a highly tested CPA concept. All right, so a dividend is only taxable if it comes from earnings and profits. All right, so we're going to think of earnings and profits like the company bank account, right? The company has all this revenue from sales, it has all these expenses, and the remaining portion is going to be the company's earnings and profit, right? So if you're thinking about the bank statement, all the cash coming in minus all the cash going out equals the total amount that is left over. This is what's still in the bank account, and this is the earnings and profits that are technically available to be distributed. They can be reinvested, whatever Planet of the Grapes wants to do. All right, so think of E&P like the corporation's version of retained earnings available to distribute. If the company has E&P, the IRS views that distribution as a true dividend. That means taxable dividend income to the shareholder. But if there's no earnings and profits, right, maybe there's a loss, then it depends on whether the shareholder has basis in their stock. All right, so there are three outcomes here. Distributions from earnings and profits equal taxable income, and that's going to be taxed as ordinary income. All right, this is the most common scenario on exam questions, but we also need to keep in mind that it might not be earnings and profits that this dividend is being distributed from. Right. So if there's no E&P, but the shareholder has basis in the company's stock, that is not taxable. So instead, we're going to reduce the shareholder's basis in the stock. If there's no E&P and no basis, okay, so this is going to be taxable as a capital gain because at this point, it's basically a gain, not a dividend. All right. So tax treatment of dividends depends on the source, not the form. Cash, stock, property, none of that matters as much as where the distribution came from. All right, so this is the hierarchy you should remember. Is earnings and profits available? If so, it's taxable. If there's no earnings and profits, we're first going to reduce the basis, which is not taxable. It's a reduction of basis. If there's still more that's being distributed, that's the excess that becomes taxed as a capital gain. All right, so this is exactly how the exam tests this topic repeatedly. Okay, so when you're thinking about dividends and how it's getting taxed, typically we're thinking taxed as ordinary income. All right, but some dividends aren't taxed like regular ordinary income. Some dividends can qualify for special lower tax rates, similar to how long-term capital gains will have those capital gains rates, whereas a short-term capital gain would get taxed as ordinary income. All right, we'll talk about that more a little bit later. So when we have a special dividend that is getting taxed at capital gains rates, this is what we're calling a qualified dividend, right? They're qualifying for those lower tax rates. All right, so to get the lower tax treatment, two main requirements must be met. The dividend must come from a US corporation or a qualified foreign corporation, and the taxpayer must meet a minimum holding period. So, what does that mean? It means they have to have held the stock for more than 60 days within the 120-day window surrounding the ex dividend date. Alrighty, so if Linda Larper buys shares and she holds them long enough and the corporation meets those requirements, those dividends can be taxed at more favorable capital gains rates instead of ordinary income. All right, so we're going to notice the term ex dividend date. This is simply the cutoff date where new buyers no longer get the next dividend. All right, so you won't need to memorize this nuance here, but you do need to know that this is part of how the 60-day rule timing works. All right, so our key takeaway is that not all dividends are taxed the same. Some can qualify for lower long-term capital gains rates if they meet those requirements. All right, so as we mentioned, not all dividends qualify for those lower favorable capital gains rates. So if we have a dividend that doesn't come from a normal public stock investment or doesn't meet those qualified rules, then it's treated as what's called a non-qualified dividend, right? It's not qualifying for this lower rate. So non-qualified dividends are still taxable, but the bummer here is that they're taxed as ordinary income at your normal marginal tax bracket. Okay, so for example, dividends from ESOP plans, dividends related to short sales, or dividends from certain foreign corporations, those are non-qualified. Same with payments from credit unions or mutual savings banks. Those are treated like traditional dividends for tax break purposes. Alrighty, so think of it this way. If the dividend didn't come from normal traditional stock investments, then it's probably not qualified and taxed just like ordinary income. Okay, so now here's a super important concept that does confuse a lot of candidates. This is called return of capital. All right, so a return of capital is not taxable dividend income. This happens when the company distributes cash to shareholders, but it does not have current or accumulated earnings and profits. All right, so the company is basically giving shareholders their own invested money back, not distributing profits. All right, so the simple tax impact here, when the shareholder receives return of capital, they don't pick up taxable income. Instead, they reduce their stock basis by the amount received. But basis can never go below zero. All right, so once basis hits zero, any additional distributions, as we mentioned, become taxed as capital gains, right? We've exceeded our basis. All right, so a little shortcut here. Return of capital equals you're literally getting your own money back, not new profit. That's why it isn't taxable until you've fully used up your basis. All right, so now we're going to talk about stock splits. And this one is super testable because it's one of the few things in the dividend world that is very clearly non-taxable. All right, so when a company does a stock split, they're increasing the number of outstanding shares that you own, but the proportional ownership doesn't change. You're not actually receiving a profit. You're just receiving more slices of the exact same pie. Okay, so from a tax standpoint, no income is recognized. There's nothing taxable here. The only impact is on basis. Okay, so if Linda Larper originally owned 100 shares with a $100 basis per share, the company does a 2-for-1 stock split. Now she has 200 shares. Okay, so it's going to be the same total basis, right? That total value is the same. It's just cut in half per share. So instead of $100 per share, her basis becomes $50 per share. And that's going to be multiplied by double the shares. So same total value, nothing taxable. All right, so our key takeaway here is that stock splits simply spread your original basis over more shares. That's it.